So as Andrew says, we're here to talk about a frequent dilemma that investors face. Should you back a fully formed operational real estate business, or should you back a management team and build something from scratch? And so we've got a fabulous panel here today. And why don't you introduce yourselves?
Yeah, hi everyone. My name's Lee Coward. I work at Oxford Properties in the investment team. For those who might not know us, Oxford is the real estate arm of one of the Canadian pension funds, OMERS. We've been an investor in Europe for the last 15 years, and we've backed several businesses, several management teams covering UK businesses, pan-European businesses, and then we also share best practice on global platform backing and management team backing as well.
Thank you. Valentina.
Hi everyone, Valentina Shagoyan. I'm a founding partner of Oprim. We are a venture investor in emerging operating companies in niche sectors. So we firmly believe that opportunity in the real estate market now lies in backing the right talent, and real estate almost comes second.
Michael Kovacs, the founding partner of Castle Forge. We're a vertically integrated fund manager and developer operator, but also have started operating businesses in a couple of the sectors where we specialize, including offices. So we have a service office platform called Clockwise, and residential, where we have a platform called Ocasa, as well as hotels and now data centers.
Hi all, Chris Walls, partner at EY. Don't know EY, the best of the big four accountancy firms. I co-lead our financial due diligence business, focused on real estate, so advising clients, buying, selling, refinancing, operational real estate companies.
Hi everyone, I'm Lisa Cations. I'm the managing director and the founder of JCR Advisors. I'm working with the investors and fund managers on operational real estate partner selection and buying, selling platforms, and then provide the operational performance oversight.
Thank you. So we're going to start off with a really broad question, because it is quite a broad topic. So we're going to start broad and then perhaps narrow down. And we are talking about backing a business or buying a platform in operational real estate. So for each of the panelists, could you please let us know what your thoughts are on this and what your experiences are?
Yeah, look, I can start. I think we're kind of different. We actually start with the real estate. So we're really starting with, based on the macro, based on our research, what are the themes that we like? What are the sectors we want to be in? What geographies do we want to be in? That's the first part. And then it really becomes, how do we best access that opportunity? And you can work with managers, you can buy into platforms, you can back management teams to build platforms. There's lots of ways to access any sector or any geography in this day and age. It's great. And so in terms of how do we go through that thought process, it's really a case of what's there to be done, what are the options, things are different sizes, there are different approaches. And so there's no one size fits all, and that's why we've ended up doing different strategies in different ways. But ultimately, regardless of whether you're backing a management team or buying into a platform, the quality of the management team is always a key defining attribute, and that's where we go first.
Yeah. Michael, what about the downsides of buying a platform?
I mean, at the end of the day, a lot of platforms are people. So, it's sort of, there's an IP element to all of it, but at the end of the day, it is keeping the people going in that platform that's super relevant. I'd also say there's downsides to building a platform as well from scratch. I mean, I think our view on this is, like Lee, we start with the real estate and then think, okay, how do we access it? But if you look at any operating business, and it's not just real estate, I think it's a lot of businesses, there's kind of a U shape of operations. So you start with one site, one location. It's probably the best run site on earth because you're running it, right? And then you get to like 1,000, and it's also really well run too, because you probably make enough through management fees, et cetera, to go hire, the New York Yankees or whatever it is. But somewhere in the middle, 20 sites, 50 sites, and I know guys who do this, like they operate, quick service restaurants. That's a really tough business because you're trying to scale. It becomes so much more complex. And then at the same time, are you sure that you have enough scale and operational, revenues coming in, management fees coming in to basically run it? And so it's about getting through that. And then you have to take into the context, okay, well, how long do I have to grow this business too? Because depending on the type of capital I have, is it evergreen? Is it 3 to 5 year private equity capital? I think there's just so many, it's literally a case by case basis. I think you need to look at it that way. There's really, I'd say that there's no right way to do it. It depends exactly on what you're trying to do and like how hard or easy it is to scale in that business and how long your capital is.
Yeah. And Valentina, you have thoughts about buying a platform if the sector is still emerging?
Yeah, I think that the answer here is a little bit more nuanced. Everything depends on what capital you represent. If it's more of an institutional capital that is looking to gain scale in an existing and established sector quickly, I think that it's a clear case for buying an existing platform and just going through all the usual due diligence process, which team is best to back, but that's where you would immediately want to deploy hundreds of millions. If you're looking, as the question that was posed, into more emerging sectors, and you represent capital that is looking for clear differentiation on capital markets, becoming an expert and manager that drives returns by being an expert in a given vertical, it's a clear case for backing emerging management companies and building around that expertise, further raising into the real estate strategy, and then becoming that vertically integrated platform in due course that will be a specialist manager in a niche sector. And then this platform is a perfect target for an institutional capital to play and buy when they exit, and effectively providing exit for this type of an investor. So I'm looking at it through the lens of risk return. So if you are looking for more stable returns and you're more risk averse, buy an existing business. If you're looking to differentiate yourself through moving up the risk curve and effectively knowing how to manage that risk, and that's the value prop for your investors, then back an emerging business and then become very hands-on.
Great. And Lisa, what about if you don't have a presence in the market in that particular area?
Yeah, absolutely. So I think the route to market is really buying the existing platform and sort of gaining the scale, gaining the market share. Again, it depends on the appetite of the investor, how much involvement they want to take into the sort of operational excellence and demonstrating growth and scale. In the fragmented market, it might be really hard to buy an established operator. So if an investor is looking to gain a foot in the door and sort of at least buy a smaller operator and grow them within the market through different consolidation strategies, or maybe buying several small operators and merging them, that could be a way as well. But I think if an investor is more sort of passive, buying into platform is definitely the right way to do that.
Great. And Chris, what are you seeing about sort of growth and exits?
So I guess from a transactions perspective, large platform deals are just taking an absolute age to get over the line. Yes, bid-ask spread on price, cost of debt, etc. But the other struggle is, what is the exit strategy? Well, what is the growth strategy and what is the exit strategy? So you might have a great platform that's stabilized, underlying ops are fantastic, but there needs to be something to add, right? Some magic or some sprinkle to take it on. And then, lack of IPO market for the larger platforms is, again, like, what is the exit strategy? So we're seeing a little bit of stickiness or a number of transactions that we'd like to get over the line and haven't yet. And then on the smaller side, we've seen a number of new ventures, right, in the real estate operational real estate space, like Modal, Greykite, Martley, etc., which I think is really interesting.
Great, thank you. So that's sort of general thoughts, and now we're going to sort of dive into some more specific points. Lee, what are your thoughts about integration challenges, and what have you experienced in relation to that?
Yeah, I mean, we've had a really broad range of founders, senior leadership people. I think it depends what you want out of the business. If you want to create a subsidiary that happens to be just sat outside your business, you can be tempted to go for full integration. You want them to think the way that you think. You want their processes and procedures to be the same as yours. Invariably, that doesn't get the best out of the teams or the people. That's not really why we want to buy them. We want to work with management teams, with platforms, because they can do things differently in a way that we can't necessarily do ourselves. Otherwise, we would just hire employees and build it ourselves. So I think it's really important to allow them to have their own identity, but there are fundamental building blocks that you want to have in place. So regardless of whenever you think a platform might distance you as an institutional investor from reputation risk and whatever other risk, it's just not the case. Whenever you see any reporting about any of our platforms, it pretty much always names us, Oxford-backed X platform. So key building blocks such as proper governance structures and whether it's health and safety in residential, whether it's reporting, whether it's whatever else, you've got to have those bits in place. But for us, the day-to-day operations, their use of technology, that tends to be bespoke, and that's where we feel that we shouldn't be imparting our ways on them. They should be telling us what best practice is in their geography and their sector and whatever that is. So I think that's finding that
more about
super
culture
important.
and finding the fit within the organisation.
Exactly, yeah. The bits that we do well that we can bring, ESG is a really good example where actually we'll have global ESG coverage in a way that no individual platform will ever get. And so actually that's an area where we should be saying, this is what we think global best practice looks like, and we would like you to implement this. Operating residential units, not necessarily the case, and actually we should be listening to them and they should be telling us how to do it properly.
I think the real challenge also is to marry mentality of an operating partner and the investment manager, in the sense that real estate for the last few decades have become a financial asset, and now it's transitioning into operations. And if you ask an investment manager who your client is, they will tell that our clients are our institutional investors, and we report based on all the usual KPIs, net income, occupancy. And if you ask an operator who your client is, they will be talking about an occupier, and those are very different KPIs that are attached to it. And marrying these two mentalities in a vertically integrated investor are incredibly hard, incredibly tough. Why this marriage works is because operator is looking for an investment manager to raise capital and to fund manage, and the investor looks at for operational expertise within their operating partners. But the conversations that happen behind closed doors that are very intense, they tend to be very intense as to what actually drives value in real estate. And I think there is a certain level of stickiness within the investor world that the old KPIs are the ones that should be imposed, because again, that's the way how their business function and business success has been reported up. So I don't know how you solve this equation within your organization, but it's now a point of tension.
Yeah, look, tension I think is healthy in some of these situations. I think you want to give them rope, but not too much. There's no right answer. We kind of like to hopefully set out on the right track, which is day one, let's make sure we each understand what we're looking to get out of that relationship. Some people just want you to write big checks and get out of their way. If we know that we're going to be much more hands-on with that, we want to be upfront about that. Otherwise, it's just going to lead to problems down the road, and that's not going to be healthy for anyone. So I think setting out your stall at the outset is the only way these things work.
Okay, I'm going to jump in and also ask a question. It's like, I think, Valentina, I agree with you. Real estate's becoming a lot more operational. And so, you can almost see yesterday's operating partners 10, 20 years ago that work with capital partners on deal-by-deal projects as kind of today's operating businesses. But actually, if you look at 20 years ago, it's not like every institutional investor owned the operating partners either. These were kind of operating partners for hire. Why would it be the natural state that institutional investors should own the operational business as well, unless it's like a special case? So maybe that's just a question. It's like, does every operating business need to be owned by an institutional investor? Does every institutional investor need to start or buy an operating business? Why would that even be the default case?
Yeah.
That's a question.
I can answer some of that, because I think if you'd have asked me this 5 years ago, I think platform value would have been the answer. I think
Sure.
everyone thought there was a magic 10% platform premium, and that's how you make your investment memo stack in an environment where you were maybe low yielding and whatever else, and it seemed like a good outcome. And in some cases it played out, but I don't think. I think if you ask most institutional investors today, they wouldn't underwrite platform value. It then becomes more about brand control and consistency and reputational protection.
Or just deploying huge amounts of money through it.
Or
But like, there's not that many sectors or geographies or existing aggregation abilities that you can plow a lot of money through, right? So it's like, I just don't even see that it's necessarily the default case.
And Chris, when you're looking at these from a due diligence perspective, I mean, I know what I look at from a legal, corporate, and other legal aspects. But from your perspective, what are you looking at?
So from a financial diligence perspective, it's all about value and risk. So finding or confirming the value and then mitigating the risk. For a startup, smaller business, it's all about the forecasts. So to your point, Michael, on you've got one that's really good, but how do you get that to 100? So clients will ask us to comment on the forecasts. And for us, really, it's what's the track record, right? So you might not have had the ramp-up track record, but you've got the relationships or the niche, the tech, the relationships, what have you, for that growth. And it's quite similar for the larger transactions as well. So for a pipeline, for a big platform, again, forecasts will be a real focus area for us. And typically, with a large platform or a listed business, once you start kind of peeling the onion and getting into the detail and the underlying numbers, they're not quite, what they made up to for, in the IM or the teaser. So.
And I suppose there's a difference also, isn't there? Because the numbers can only tell you so much. You might have an underperforming business, but that it's got great potential, and you really believe in the business itself. When does it make more sense to buy an underperforming business? I don't know, Lisa or...
Yeah. So I'm actually quite a lot involved when the investors are bringing me in to advise them on sort of beyond just sort of the financial due diligence, just getting into the operational excellence and understanding the operations and seeing where there is a secret sauce that maybe if the business is not performing because they've grown so much, or there's been just sort of a lot of the sort of overhead costs, and then they were trying to acquire the market share, but fundamentally they're in the right place and there is the right tech stack. So I think you're right in a way that there might be some businesses that are underperforming in the short term, but then there is a bigger sort of growth potential, and that's where again the investor needs to look into the operational side of things really forensically, because that's where understanding the business specifics, the marketplace, the customer demands is becoming so important, especially in the fragmented marketplace where I'm advising some flex operators, some of the again, more sort of at the intersection of living and co-working, and it is becoming really important to understand the customer demands, and a lot of the times, as Valentina just rightly pointed, the investors, they think of their customers as different sort of customers as they actually end users. So again, understanding and getting aligned of where the demand is coming from, what is the potential, what is your defensibility of the business model, and how you can protect that is becoming really important. And that comes from real understanding of the operational side of things.
And that's really helping them weigh the pros and cons of the different options available.
Yeah.
Okay. So we thought we'd do things slightly differently. We thought we might start a bit early with questions. I've got more questions to ask the panel, so if we run out, that's fine, we'll go back. But we thought it might be interesting to get from the audience some thoughts and questions, if there are any. Thanks, Andrew.
Interested in the panel's views in terms of the sort of change nature of real estate investment, which is very much what we're talking about. So historically, when we thought about real estate investment, because we have bonds, we have equities, and somewhere in the middle we have real estate. But if I look on this panel, I look at Valentina as much more like a VC than you are a PE, for example. And in terms of that operational focus, do we need to sort of relegate that historic way of thinking about real estate and start thinking anew?
I can jump in to start answering this question. So if you again go back to the times when this allocation has been built in the minds of portfolio managers, real estate has been identified as an asset class that delivers inflation protection, long yield, low risk, and most importantly, uncorrelated returns to equities and bonds. And that's what portfolio theory is telling us is the right way to define an asset class to be added to portfolio of assets, because then the benefits of diversification is unlocked. The reality is, once real estate started moving into more operationally intensive business class, where returns for real estate as a property very much correlated with operations that are run within the building, that means that real estate is becoming more and more correlated with private equity and with equities in general, and that is becoming problematic. So real estate, when it comes to portfolio theory, as an independent and distinct asset class that continues delivering this long-term low-risk returns, is actually, in fact, shrinking. And there is a big part of real estate that starts behaving like equities, where people are still getting their heads around what is the right alignment to capital sources, or what the right alignment to capital sources would be. It is becoming, and as such, for this part of real estate, it is required to deliver better returns, because private equity as an industry, as a sector, is a higher risk, higher returns. So then as a real estate investor, you try to compete with this pocket of capital, moving up the risk curve. And I want to tie it back to another question that was asked about their internalization of operational expertise into asset managers, into investment managers. If you're moving up the risk curve, you've got to control the risk. You can't just simply say, oh, now I'm going to be an investor into student housing or senior living, and they'll find an operator. Well, this operator is the key expertise on that portfolio. So you've got to somehow either fully internalize or rely on your partner where you own some sort of an equity stake to deliver or to credibly claim that you can play this asset class. You can actually deliver this private equity type returns and then address this bucket of capital. And there's another major issue there. If you don't do it, you're at the risk of disintermediation. I have an example as a venture capitalist. There is a startup in Spain that does senior living units management. And they started their business as a pure play OpCo. They said, listen, we don't know real estate. We know how to service this type of the market. We are venture capital prop that will be moving into private equity. What happened over time, they started delivering such a great return on their underlying assets that they said, listen, what stops us from moving and raising capital off of Oxford Properties or any other institutional investors and playing PropCo ourselves? So unless you move and make this integral part of your story, their specialism and operational expertise from within, you'll start being disintermediated by operating companies that they will start raising PropCo funds on the side and be successful at it, because they have track record of delivering by far better returns than real estate investors who tend to be passive. Sorry, it was a long answer, but it's a lot going on there.
No. Michael, you're looking very thoughtful.
Gosh, that's a hard one. Yeah, I mean, listen, I'd agree with a lot of that. I think that there's fewer and fewer assets out there that provide like an income. I actually think income will probably be one of the biggest focus for real estate investors over the near to medium term. It's something that kind of fell on the back burner. And, you know, if you look at people like Andrew Jones out there, he's basically saying like, look, this is what real estate was supposed to do. It's supposed to be operated by experts and deliver a return that's pretty consistent. On Valentina's point, I mean, listen, I think that it probably depends on like what sector you're talking about. If it's an established asset class where you can then expand very quickly and deploy lots of capital, I do think that makes a lot of sense. I think that if it's not, I mean, look, if you look at Blackstone, what were the platforms that they did really well on within the fund, right? Where it was like a short period of time. Invitation Homes. Well, that's because they could go out there post GFC and buy like 100,000 houses out of receivership. They didn't have to build any houses. Mileway and Logicor basically could just go out there and aggregate tons of last mile logistics that were there that kind of people wanted. And anybody heard of movie studios recently? No, of course not, because like you have to build this stuff. And it's really hard to do. You look at hotels. You know, there are so many hotel platforms that are kind of at that 10 or 20 hotels in Europe. You go out to the US, and when they started extended stay, there are plots all along like I-95 that you can build 1,000 hotels over the course of 5 years if you wanted to and get your platform to scale. So I think that when it comes to thinking about like which platforms you want to start or how easy it's going to be to get through that U shape and that scale, I know this is kind of a bit off topic, but like I think what you really need to think about is like how quickly can I either build or buy this real estate? Because if I can't do it quickly, there's not really a point in doing it, actually.
They're pretty smart over there at Blackstone, aren't they?
They are. They know what they're doing.
Village Hotels was an example where talking to some clients, they were kind of questioning what's the growth story, what's the exit, and Blackstone luckily bought it, and they're growing already. So they saw something that others didn't. So good luck to them.
I'd say I think the emergence of real estate credit is partly a contributor to this. I think that stepped into a place that provides a pretty relatively passive, very stable, cash flowing return. You know, we have a global credit book. It provides an average return of 9, 10, 11%. They're still consistently pumping out money,
Yeah.
and it's meant the equity strategies have had to work harder to get a return that looks like an appropriate premium versus what you can get in real estate credit. And then there's only so much you can do with long let offices, long let retail, 5-year upwards only rent reviews. Whereas I think when we look at operational real estate, you can move the needle on a daily basis, on the cost side, on the rent side, on the business model side, scale, everything. And so I think that has really been a big driver towards institutional capital. And we had almost nothing in operational real estate 8 years ago. And it's now more than 50% of our global allocation is into operational real estate classes. So it's been a real needle mover.
Yeah, and wait until we get inflation for the first time forever. Like you'll actually start to see, well, there is benefit to being able to kind of increase your rent annually. Credit looks great in the context of like values not moving anywhere in the city for offices for like 30 years. And then suddenly, even bad buildings are renting at 70 pounds a foot, which is the prime rent. So you're actually capturing the equity growth. So I think the world's just, I don't know, it'll change. It'll be very, very different over the next couple of years.
Lisa?
I'm just reflecting more on what Valentina was saying and just want to give a few examples from her point of view when investors need to become more operationally involved. And examples like Goldman Sachs are building their own operating platforms. And I'm sort of debating in my head and want to also just address this question to the panelists in terms of what would be the best sort of combination of investors becoming more operationally savvy, or whether it's just some sort of JV structure where they are still staying as a sort of oversight or more passive sort of involvement, and then allow the operator to really excel and kind of do their job and believe that they're doing an excellent job. And what I'm trying to get to is the lines are literally blurring as we speak, because some institutional investors think that they can operate and build it from within. But then, you can discuss sort of the innovation. Is there a true innovation there? Because those hungry small operators that scale, they're literally so eager to innovate, to service the customers in the best possible way. And then when they become more institutionalized, to Valentina's point, sort of, can they really attract the capital and become this investment manager with the operational lens? Can they actually effectively manage capital? The question really still becomes unanswered. And I'm advising one of the owner operators at the moment, and they own 60 assets in central London, and they're also an operator with 30 years of history. And what is fascinating is to see how the investor who becomes more operator is becoming more complacent, and they're losing this innovation sort of spirit. And I think there is still a debate to be had whether it's an effective model for investors to become more operator focused, or whether it's still allowing those smaller businesses, as we just discussed, sort of buying into a smaller platform and allowing them to scale. How can we preserve the innovation? How we can encourage this without killing it as we start to integrate them more into the sort of investment platform? So I think this is still a debate to be had, and yet to see who is going to be the winner.
On the innovation thread, obviously this morning we've had a lot of discussions around AI and technology and how they can be used within the sector, how they are being used, what the future looks like, perhaps some conflicting predictions about what the future looks like. So it's obvious that technology in itself is pivotal to any business, and this sector potentially could do more. I'm not sure I fully agree that it's going to outsource everything, but because we're still a people business. But when you're backing a business, how critical is an existing tech stack or some sort of roadmap around technology or AI, whatever you want to call it? Or would you just be happy with using some sort of proprietary technology or something that's already embedded? Perhaps, Lisa, could I go to you first?
I can
that?
comment on that. Yeah, absolutely. So a lot of times when, again, I'm looking at the investors sort of underwriting the deals and buying the operating platforms, I actually see quite low enterprise value assigned to the tech, and even the understanding of, is this a best-in-class tech stack for the operating platform? It's not even, and Chris, I'd love your input on that. It's like, it's not even sort of getting enough attention as part of the due diligence, and there's so much value in it, and equally an opportunity to improve the efficiency and operational excellence through more sort of embedded or seamless technology solution. And that's where I do believe there is an opportunity for the both big platforms and the scaling operating businesses to differentiate themselves, and equally for the investors to get better understanding what is the best-in-class tech stack for a specific sector that they're buying into, to then have a view on how they can create more synergies or any sort of increase in value creation through better tech. Chris, what do you
I completely agree. It's not a focus, certainly not a focus on the value side or the growth side. It's just on the risk. Is there anything wrong with it?
Yeah.
As long as it's okay, as it functions, we're not going to get hacked, then talking to clients, they don't seem to care as much.
Yeah. And then in terms of, Valentina, I think you were thinking it's more important, it's becoming more
As an
and more
investor
important.
in emerging operating companies, for me, the most critical KPI is ability to scale fast. You can't scale without tech. I'm not after deep tech solutions here, and I'm not after proprietary technology either. If the tech stack is there and it's working, an example, self-storage business, if for me, as a customer, to book space or to book a box, it takes to go to the website and then fill in the form and then somebody will call me back, I think that's a killer. There is no scalable business proposition there. So they've got to give me an ability to book it for the duration that I wanted for. And also ideally there is a technology that does some sort of dynamic pricing so that discriminates me if I can afford paying more for the right location and the right duration. Is it a very complex technology? No. But is it mission critical? Absolutely yes. So this type of tech is an enabler to scale. Everything else is a little bit, it's nice to have, it's interesting conversations to be had about AI and what it does to efficiencies of the business. So being tech aware helps, certainly. But as an investor into OpCo, as opposed to bricks and mortar, tech is really critical.
The piece that we're always a bit cautious of is it's almost got to the point now where I think it's like a cookie to page in an IM, and it's probably not even written by the company, it's by the platform, it's probably written by the advisors, and we like to call it buzzword bingo, and the words move around a little bit as things change, but you can always see something that's been written to just try and hit buzzwords, and what we found over time is the people who use the most buzzwords are actually the people who've got the least sophisticated tech stack. They're trying to convince you that AI is doing everything, and it's not. It's often not the case. You actually, I'd much rather speak to a tech director guy who's in the weeds and isn't, a marketing or a sales guy, than have the sales guy come into the room and drop loads of buzzwords in. And I walk out of those meetings thinking these guys don't actually really know what they're doing. So.
I 100% agree, and very much agree with you, Valentina. It doesn't even have to be yours. When we started Clockwise, the first thing we did is we went out there. We were Office R&D's first customer. We met them back in 2016, 17. So it's stupid that we didn't actually take a stake in the business, maybe in return for something. But it's been incredibly successful. There's no way we would have been able to scale that business without that. So it's extremely important, but you don't need to own it either.
Yeah, brilliant. I have one very short question left for the panel. Andrew, do we have time for any more questions from the audience?
We have a couple coming. So
Over here.
who do you want to pick, Michelle?
This gentleman here.
Thank you. Andrew Thornton from Enterprise Land. I'd be interested to understand from the panel where they felt they've needed to adapt and amend to accommodate the operator. A lot of the chat today has been about they need to take our processes, they need to change. But it's a partnership, and seeing the humility and the ability of the capital to accommodate the operating partner. I'd just be interested in examples where that's happened.
Yeah, like I can go. I think one of the things we've learned, generally people want growth. And so actually the idea of having a platform that's captive is great until something in your capital allocation strategy changes and you have to turn off the taps. And that becomes a people challenge, and that becomes a motivation challenge, and all sorts of other things. And it's a potential source of tension. So actually, I think as we've evolved, we've tried to be upfront with ourselves day one. If we're going to get to the point where, yeah, we might cap out on allocation, we know things might change in the world. Being flexible around allowing them to pursue strategies with other third-party capital sources has been a way that we've kind of had to change our thinking to allow everyone to hopefully meet their obligations. And there's guardrails you have to put in place to make that work. And at times it can be uncomfortable, but I think that's one of the things that we've adapted to. We've seen platforms less as captive, do what we want you to do, and more reciprocal, that we want you to do this for us whilst we've got appetite. But if we don't, we want to give you free rein to grow your business, be successful, achieve what you want to achieve.
Might just provide more detailed example of how, when I was working with one of the investment managers in the UK, they wanted to set up Flex across their portfolio, and that was a sort of use case of the bigger sort of office portfolio. And what was fascinating is when they started looking into the sort of operational side of the business, how to even operate themselves, the sort of the flexible office component, there was such an alarming kind of awareness of the fact that how outdated their internal processes were on the asset management side, on the leasing, on the just purely sort of property management. When you look at the operating businesses and how much more customer-focused hospitalization of the office space is real, and even just using tech and digital platforms as distribution channels for your product, the traditional leasing team felt utterly sort of outdated because all they were doing is just engaging with the brokers and rather than enabling direct sales. So I think your question is really relevant to the investment and asset management community, because there's so much to learn from the operating businesses and adopting the traditional way of how you run, the asset management and the core business offering.
I think from a legal perspective, the area where I see is most vital is communication, because it is a partnership. And so at the very beginning, the parties involved need to understand what each expects of the other and agree that where they don't, things go wrong. And then as the business develops and operations develop, or perhaps strategy changes, having communications at those stages as well are vital, because if those communications don't happen, things go pretty wrong then as well. Can I ask my one last question, or did you want the?
You off at this
I've got.
point.
It's very quick.
Okay, go ahead.
Hold on.
Okay, so the very quick question is: it is a one-word answer from each of the panelists. Tell me, would you, if you had a choice and you could only choose one, would you choose to back a fully formed existing operational business, or would you back a management team?
We back a fully formed operational business, I think.
Well, if I was Oxford Properties, I would do the same, but as a venture investor, backing teams.
One word.
Back teams, yes. That's more fun.
One word. It depends who you are. But honestly, I'd probably back. I'd probably buy. I'm probably with Lee on this one. For most investors, I'd say you should buy.
I'd go fully formed, a lot more diligence to do.
I'll back the business and scale. Yeah.
Brilliant. Thank you.
Michelle, great job.